Right now, half of the internet insists that artificial intelligence is a massive financial bubble waiting to burst. The other half argues it is the most significant leap in productivity tools since the invention of the internet. Both sides are focusing their energy on the wrong metric. The current debate centers on user adoption, app growth, and revenue. This is the demand side of the equation. Demand is a noisy indicator. It is easily manipulated by media narratives and changes depending on which software a company is trying to sell you. To understand the actual economic trajectory, we have to look at the supply side. While demand can be manufactured through hype, supply requires real, upfront capital commitment. You cannot fake the hardware. This year, the world's largest tech companies are projected to spend $725 billion on artificial intelligence infrastructure. That's roughly $23,000 every second. This chart shows how much that spending matters. In the first half of the year, this build-out in information processing accounted for roughly 92% of all U.S. economic growth. Without this AI investment, the American economy grew at only 0.1%. The mechanics of this build-out follow the capital cycle theory, a framework dating back to Adam Smith in the 1700s. It suggests that when a new industry offers high perceived returns, capital rushes in, attracting competition that eventually drives those returns down for everyone. The cycle begins with stage 1, the flood. This is the moment capital pours into a new technology indiscriminately, as investors chase the earliest high returns. We saw this in the 1830s, during the British Railway Mania. Everyone from institutional bankers to local clergymen piled into railway stocks because they feared being left behind by a rapidly industrializing economy. This leads to stage 2, the boom. In this phase, companies overbuild infrastructure to keep their share prices high, causing the total supply to outpace what the market actually needs. Today's AI boom hides oversupply by manufacturing demand through circular financing. NVIDIA invests in OpenAI. OpenAI pays Oracle for computing, and Oracle uses that revenue to buy more NVIDIA chips. Each move is recorded as new demand. This strategy, known as vendor financing, was the primary driver of the fiber optic bubble in the late 90s, where equipment manufacturers lent their own customers the money to buy their products. Eventually, the math of the cycle takes over. Increased competition and oversupply lead to compressed profit margins, regardless of how much capital is circulating within the industry. Now the third stage is the collapse. This occurs when the overwhelming supply finally breaks the market's ability to generate returns, leading to falling prices and corporate failures. Historical precedents are consistent. It happened with the 80 million miles of unused fiber optic cable in the early 2000s, and again during the shale oil bankruptcies of the mid-2010s, when supply outstripped global demand. Early indicators of this phase are now appearing at OpenAI. While they were once the only major player in the space, they now face aggressive competition from Google, Meta, and Anthropic. Leaked financials show OpenAI is facing a projected $38.5 billion loss. More importantly, their marketing spend jumped 400% in a single year. They are spending billions just to maintain their current user base against new competitors. This fragility extends to the hardware providers. When chipmaker Broadcom reported a minor guidance miss in June, the market reacted by erasing $300 billion of its value in a single day. These financial losses and extreme stock reactions suggest that the AI industry is following the historical pattern toward the collapse phase, where the weight of the massive supply begins to strain valuations. The collapse makes way for the fourth and final stage, the inheritance. At this point, original investors lose their stakes and capital retreats, leaving the physical assets behind. This inheritance consists of the physical backbone of the industry. The massive data centers and server racks built by today's companies will remain in the ground long after the initial investment capital has vanished. This dynamic is described by the business adage, the pioneers get the arrows and the settlers get the land. Pioneers like Alta Vista and Lycos spent millions in the 90s to build the first web crawlers and educate the public on what a search engine was. They absorbed all the initial risks of an unproven market. Settlers like Google then entered the market, utilized the established infrastructure and consumer awareness, and captured the value without having to pay for the pioneers' mistakes. The capital cycle suggests that the largest opportunities exist for those who acquire this infrastructure after the pioneers have absorbed the initial risks. In the long term, bubbles are the mechanism the economy uses to build the future, even if the builders themselves don't survive to see it.